Why should you care about investing your money? It's a very good question to ask yourself. Think about the money you earn from your hard work. If you just keep it tucked away in a savings account or under your mattress, it sits there. It doesn't really do much to help you, does it? Worse yet, over time, the prices for everyday things like bread, milk, and gasoline tend to go up. This is something economists call inflation. If your money isn't growing at least as fast as inflation, it's actually losing a little bit of its buying power each and every year. Investing is a powerful way to fight back against this sneaky thief called inflation. It's all about making your money work hard for you, generating more money, even while you are busy with other things or sound asleep. Investing is a bit like planting a special kind of seed. You take some of your money, which is like your seed capital, and you plant it carefully in a good spot. At first, when you look, nothing much seems to be happening on the surface. You have to be patient and give it time. But with consistent care, and if you chose a fertile ground for your seed, it can start to sprout roots and grow. It can grow into a small plant and then, over many years, perhaps into a big, strong tree. This magnificent tree can then provide you with fruit year after year. This fruit is like the returns or profits you get from your investment. Your future self will most certainly thank you for having the foresight to plant those seeds today. It does take some initial effort and learning, but the potential long-term rewards can be truly wonderful and life-changing. This essay is designed to be your friendly guide. It's here to help you understand some of the most common and basic ways to invest your money. We are going to talk about things called stocks, which mean owning a part of a company. We will also look closely at bonds, which are like lending money to an organization. Then we will explore mutual funds and exchange-traded funds, often called ETFs. These fancy-sounding names might seem like complicated Wall Street jargon at first glance, but I promise you, the fundamental ideas behind them are actually quite simple and easy to grasp. You definitely don't need to be a mathematical super genius or possess a fancy degree from a prestigious university to get started. Many of the most successful investors I know are ordinary, everyday people. They just took the initiative and the time to learn the basics, and you can certainly do it too. Understanding these simple investment tools is really very important for your long-term financial well-being. It's a significant first step towards achieving better financial health and security. Think of it like learning how to use the essential tools in a carpenter's workshop. If you understand how a hammer, a saw, or a screwdriver works, you can build something amazing, like a sturdy chair, or even a whole house. These different investment vehicles, stocks, bonds, mutual funds, and ETFs are your financial tools. Learning about them, how they work, their potential benefits, and their inherent risks empowers you to make smarter, more informed choices with your money. These choices can help you build wealth steadily over your lifetime. This wealth can then help you achieve your important life goals, like enjoying a comfortable retirement, buying a home, or funding your children's education. It's about taking control of your financial destiny. So, what exactly are these things called stocks that you hear about so often on the news? Well, the idea is quite simple and straightforward, really. When you buy a stock, you are actually buying a tiny piece of a company. That's right, you become a part owner. Imagine a big, well-known company, perhaps one that makes your favorite brand of sneakers, the computer you use, or the coffee you drink every morning. If you buy shares of their stock, you effectively own a little slice of that entire business operation. You become a shareholder just like the original founders or major investors, but obviously on a much smaller, individual scale. It's like owning one single brick in a very large and impressive building. That brick is yours and you have a claim to it. This ownership stake gives you a claim on the company's assets and, importantly, a share in its future profits, which is a pretty neat concept when you stop and think about it. To make this even clearer, let's think about your favorite local pizza place. Imagine it's run by a really talented chef and is always busy with happy customers. Now, if that pizza place decided it wanted to expand and open more locations, it might decide to become a public company. It could do this by selling shares of stock to the public. If you bought some of those shares, you would own a small part of that growing pizza business. Your slice of the company is represented by the stock certificate, or more commonly today, an electronic record. The more shares you own, the bigger your slice of the pie becomes. This is the fundamental principle of stock ownership. You are investing in the future prospects of that business, hoping it becomes even more successful. Why do companies decide to sell stocks in the first place? It's mainly about raising money, which is often called capital. Growing a business costs money. Companies need funds to develop new products, build new factories, expand into new markets, hire more employees, or even to acquire other smaller companies. Instead of borrowing all the money from a bank, they can choose to sell shares of ownership to investors like you and me. This way, they get the cash they need without taking on debt. In return, the investors who buy the stock get to share in the company's future successes. It's a partnership in a way between the company and its shareholders. The company gets resources to grow, and shareholders get the potential for growth in their investment. When you decide to buy a particular stock, you are essentially betting on that company's future success and profitability. You believe that the company will do well over time. You might think its products are great, its management team is smart, or it operates in a growing industry. If the company indeed prospers, makes more money, and expands its operations, then the value of your piece of ownership, your stock, is likely to become more valuable over time. Of course, there are no guarantees in the stock market, but the basic idea is that by picking good companies or companies you understand and believe in, you have a chance to see your investment grow as the company itself grows. This is the core appeal of investing in stocks for many people. There are two primary ways that owning stocks can potentially make you money. The first, and often most talked about way, is if the price of the stock goes up. This is known as capital appreciation. Let's say you buy a share of a company for $10. If the company does well, and other investors also want to buy its stock, the demand for those shares increases. This increased demand can push the price of the stock up. Perhaps after a year or so, the stock price climbs to $15 per share. If you decide to sell your share then, you would make a profit of $5. That $5 is your capital gain. This is how many investors hope to build wealth with stocks over the long term, by buying shares in good companies and holding them as they grow in value. The second common way stocks can put money in your pocket is through something called dividends. Some companies, especially older, more established ones that are consistently profitable, choose to share a portion of their profits directly with their shareholders. These payments are called dividends. They are usually paid out on a regular schedule, perhaps quarterly or annually. So, in addition to any increase in the stock's price, you might also receive these cash payments. Not all companies pay dividends, however. Many younger, fast-growing companies prefer to reinvest all their profits back into the business to fuel further growth. But for companies that do pay them, dividends can provide a nice, steady stream of income for investors. However, it's very important to remember that investing in stocks also comes with risks. Stocks can, and sometimes do, lose money. If a company performs poorly, perhaps it makes bad business decisions, faces new strong competition, or the economy slows down, then its stock price can fall. If the price of the stock you own drops below what you paid for it, and you decide to sell, you will lose money. This is the fundamental risk of stock investing. There's no guarantee that a stock price will always go up. Sometimes, even good companies see their stock prices fall due to broader market worries or temporary setbacks. It's part of the game. The stock market as a whole is known for its ups and downs. It can be quite volatile, meaning prices can change quickly and sometimes dramatically. It's often compared to a roller coaster ride with thrilling climbs and stomach-churning drops. It's absolutely crucial to remember this characteristic of the market. Don't panic and make hasty decisions every time there's a dip or a scary headline in the news. Successful long-term investing often involves staying calm during these turbulent periods. Understanding that volatility is normal can help you stick to your investment plan and avoid selling at the wrong time out of fear. Patience is a virtue in the stock market. Now, let's talk about another important type of investment: bonds. While stocks represent ownership in a company, bonds represent debt. When you buy a bond, you are essentially lending your money to an organization. This organization could be a company, just like the ones that issue stock. Or it could be a government, like your city government, state government, or even the federal government. These entities borrow money for all sorts of reasons. A company might borrow money to build a new factory. A city government might borrow money to build a new school or repair roads. The federal government borrows money to fund its various operations and programs. Think of a bond as a formal IOU, or a loan agreement. When you purchase a bond, the entity that issued it, the borrower, promises to pay you back the original amount of money you lent them. This original amount is called the principal or face value of the bond. They also promise to pay you extra money for the privilege of using your money over a certain period. This extra money is called interest. So you are acting like a lender, and the bond issuer is the borrower. This is fundamentally different from stocks, where you are an owner. With bonds, you are a creditor. This distinction is very important when considering risk and potential returns. So, how does the process generally work? You give the government or company your money now by purchasing their bond. They then use that money for their specific projects or general funding needs. In return for your loan, they agree to make regular interest payments to you over the life of the bond. These interest payments are typically made at a fixed rate and on a set schedule, for example, every 6 months or once a year. Then, at a specific future date, known as the maturity date, the issuer is obligated to return your original principal amount in full. It's a structured way for organizations to borrow funds from a wide range of investors. Bonds are often considered to be a safer type of investment compared to stocks. This is because bondholders are creditors, and if a company gets into financial trouble, it's generally obligated to pay its bondholders before its stockholders receive anything. The interest payments from bonds can also provide a more predictable stream of income. However, safer does not mean no risk at all. There are still risks involved with investing in bonds, such as the possibility that the issuer might not be able to pay you back. We will look more closely at the benefits and risks of bonds in the next section, so you can understand their place in a balanced investment strategy. Section 5. The steady path, how bonds work, and their role in your plan. Bonds typically operate on a clear and predetermined schedule. One of the key features of a bond is its maturity date. This is the specific date in the future when the issuer of the bond promises to repay the investor the original principal amount, also known as the face value, of the bond. Maturity dates can vary widely. Some bonds might mature in just a few months or a year. These are often called short-term bonds. Other bonds might not mature for 10, 20, or even 30 years or more. These are long-term bonds. Knowing the maturity date gives you an idea of how long your money will be tied up if you hold the bond until the very end. Another important aspect of how bonds work is the payment of interest. As a bondholder, you usually receive regular interest payments from the issuer. The amount of interest is typically based on the bond's coupon rate, which is a fixed percentage of the bond's face value. These interest payments are often made semi-annually, meaning twice a year, although some bonds might pay annually or even monthly. For many investors, especially those looking for a steady and predictable income stream, these regular interest payments are a major attraction of investing in bonds. It's like getting a regular paycheck from your investment, which can be very helpful for budgeting or for retirees seeking income. The main benefit of investing in bonds often boils down to this predictability and perceived safety. If you hold a bond from a reliable issuer until its maturity date, you generally know exactly how much interest you will receive and when you will get your original principal investment back. This can make bonds a good option for investors who are more risk-averse or who have specific financial goals with a defined timeline. Bonds can also help to diversify an investment portfolio. Because bonds often behave differently than stocks. For instance, when stock prices are falling, bond prices might be stable or even rise. They can help to cushion your overall portfolio against big swings in the market. However, it's crucial to understand the risks associated with bonds. One primary risk is called default risk, or credit risk. This is the risk that the bond issuer, whether it's a company or a government entity, might fail to make its promised interest payments or fail to repay the principal amount at maturity. If the issuer goes bankrupt, bondholders could lose some or all of their investment. Another significant risk is interest rate risk. If overall interest rates in the economy rise after you buy a bond, the fixed interest rate on your bond might look less attractive compared to new bonds being issued. If you need to sell your bond before its maturity date in such an environment, its price might be lower than what you paid for it. Section 6. Teaming up for success, the power of mutual funds. Let's now explore another very popular investment choice, especially for folks who are just starting out or prefer a more hands-off approach, mutual funds. So, what exactly is a mutual fund? Imagine a big collective swimming pool. Instead of water, this pool is filled with money. Many different investors, people like you and me, decide to put their money together into this large pool. This combined sum of money is then managed by a professional. This professional is called a fund manager or a portfolio manager. Their job is to take all the money in that pool and invest it according to a specific strategy or objective. This professional fund manager is responsible for making all the key investment decisions for the mutual fund. They decide which specific assets to buy, when to buy them, and when to sell them. Depending on the fund's stated objective, the manager might invest the pooled money in a wide variety of things. For example, some mutual funds invest primarily in stocks of large companies. Others might focus on stocks of smaller, growing companies. Some funds invest in bonds, while others might invest in a mix of both stocks and bonds, or even in other types of assets like real estate or commodities. The fund manager uses their expertise and research to try and achieve the fund's investment goals, such as growth or income. When you decide to invest in a mutual fund, you don't buy the individual stocks or bonds that the fund holds directly. Instead, you buy shares of the mutual fund itself. Each share you purchase represents your proportional ownership in the overall pool of investments held by that fund. So if the total value of all the investments in the fund goes up, the value of your mutual fund shares is also likely to increase. Conversely, if the fund's investments perform poorly, the value of your shares could decrease. It's a way to own a small piece of a much larger, professionally managed collection of investments. Mutual funds have become an extremely popular way for people to invest their money. They are often particularly appealing to beginner investors or those who don't have a lot of time or expertise to research and pick individual stocks and bonds themselves. One of the biggest advantages they offer is immediate diversification, which means spreading your money across many different investments. This can help to reduce risk. We'll talk more about diversification and other benefits, as well as some of the potential drawbacks like fees in the next section. But the core idea is that mutual funds allow you to easily team up with other investors and a professional manager. Section 7. Diversification made simple. The workings and wonders of mutual funds. One of the single biggest and most often cited benefits of investing in mutual funds is something called diversification. This is a fancy word, but it simply means not putting all of your eggs in one basket. Think about it. If you invest all your money in the stock of just one single company, and that company runs into serious trouble, you could lose a very large portion of your investment. A mutual fund, on the other hand, typically invests in dozens, sometimes hundreds or even thousands of different securities, like various stocks or bonds. This automatically spreads your investment risk across many different companies, industries, or even countries. This broad diversification offered by mutual funds can be a real advantage. If one particular investment within the fund performs poorly, there's a good chance that other investments in the fund might be doing well, or at least holding steady. This can help to cushion the overall impact on your investment and potentially reduce your overall risk. It's like having a built-in safety net. For an individual investor to achieve a similar level of diversification on their own by buying individual stocks and bonds, it would require a significant amount of money and a lot of research and effort. Mutual funds make achieving this diversification much easier and more accessible for the average person. Another key advantage of mutual funds is the professional management they provide. Most mutual funds are actively managed, meaning there is a dedicated fund manager or a team of managers who are constantly researching, analyzing, and making decisions about which investments to buy and sell for the fund. These managers are typically experienced professionals with access to extensive research tools and market information. For many people who lack the time, the inclination, or the specialized knowledge to manage their own portfolio of investments actively, relying on the expertise of a professional fund manager can be a very appealing proposition. It essentially outsources the day-to-day investment decisions. However, it's also important to be aware of the potential downsides of mutual funds. This professional management and the convenience of diversification come at a cost. Mutual funds charge fees to cover their operating expenses and to pay the fund managers. These fees are typically expressed as an expense ratio, which is an annual percentage of your investment in the fund. Over time, these fees can eat into your investment returns, so it's important to compare expense ratios when choosing a fund. Also, when you invest in a mutual fund, you are giving up direct control over the specific investment selections. You are trusting the fund manager to make good decisions that align with the fund's objectives and hopefully your own financial goals. Section 8. Modern Investment Baskets Exploring Exchange-Traded Funds, ETFs. Now let's turn our attention to another increasingly popular investment vehicle called an exchange-traded fund, or ETF for short. In many ways, ETFs share some similarities with the mutual funds we just discussed. Like mutual funds, ETFs also hold a collection, or a basket, of different investments. This basket could consist of various stocks, a range of bonds, commodities like gold or oil, or even a mix of different asset types. So when you invest in an ETF, You are also getting exposure to a diversified portfolio of underlying assets with a single purchase, which is a very convenient feature. The most significant difference between ETFs and traditional mutual funds lies in how they are bought and sold. Traditional mutual fund shares are typically purchased directly from the fund company or through a broker, and their price is usually calculated only once per day at the end of the trading day. This price is known as the net asset value, NAV. ETFs, on the other hand, are traded on major stock exchanges, just like individual company stocks. This means you can buy and sell shares of an ETF throughout the entire trading day, and their prices can fluctuate constantly based on supply and demand, similar to how stock prices change. This intraday trading flexibility is a key characteristic of ETFs. A large number of ETFs are designed to track a specific market index. An index is essentially a curated list of investments that represents a particular segment of the market. For example, the S&P 500 index tracks the performance of 500 of the largest U.S. companies. An S&P 500 ETF would aim to hold all, or a representative sample, of those 500 stocks in the same proportions as the index. This investment approach is known as passive investing or index investing. The idea is not to try and beat the market by picking winners, but rather to match the performance of a particular market benchmark, minus some small fees. This is a common strategy for many ETFs. ETFs generally offer several attractive benefits. They often have lower expense ratios, fees, compared to many actively managed mutual funds, especially index tracking ETFs, because passively managing a fund to mirror an index is typically less costly than active stock picking. Like mutual funds, they provide excellent diversification. The ability to trade them like stocks throughout the day also offers flexibility and price transparency. However, like stocks, you might have to pay a brokerage commission when you buy or sell ETF shares, although many brokers now offer commission-free trading for certain ETFs. And of course, the value of an ETF can go down as well as up, so they are not without risk. Section 9. Building your financial future. Why knowing your investment tools matters. Throughout this discussion, we've taken a look at 4 of the most common investment vehicles: stocks, bonds, mutual funds, and exchange-traded funds, ETFs. Each one of these is like a different tool in a well-stocked financial toolbox. Stocks offer you a chance to own a piece of a company and share in its potential growth. Bonds are like lending money, often providing a steadier stream of income. Mutual funds and ETFs allow you to easily buy a diversified basket of investments managed by professionals or designed to track a market index. Each tool has its own unique characteristics, its potential benefits, and its associated risks. Understanding these fundamental investment tools is truly the essential first step on your journey to building long-term wealth and financial security. Knowledge empowers you. When you understand what these investments are and how they generally work, you are much better equipped to make informed decisions that are right for your own personal circumstances. You can start to think about which tools, or combination of tools, might best help you achieve your specific financial goals, whether that's saving for retirement, buying a home, or funding an education. It also helps you understand your own comfort level with different types of investment risk. It's a common misconception that investing is only for the wealthy or for Wall Street wizards with complicated financial models. That's simply not true. Investing is for everyone who wants to make their money work harder for them and build a more secure financial future. You don't need a lot of money to get started. Many brokerage firms allow you to open accounts with small amounts, and you can often invest in mutual funds or ETFs with relatively modest sums. The most important thing is to begin, to learn as you go, and to be consistent. Even small amounts invested regularly over a long period can grow into something substantial, thanks to the power of compounding. The key takeaway message is this: get started and keep learning. Your money has the potential to do more than just sit in a bank account. It can be put to work to generate more money. This knowledge about basic investment options, stocks that offer growth, bonds that offer stability, and funds that offer diversification, can help you navigate the financial world with greater confidence. By understanding these tools, you can make choices that align with your dreams and aspirations. Taking control of your financial future by learning about investing is one of the most empowering things you can do for yourself and your family. It's about building that path, one smart decision at a time towards the future you envision.